Hello, everybody, and welcome to the Tech Due Diligence session organized by the Venture Capital Association of Alberta. My name is Omi Velasco. I'm a principal of Grapha Ventures and the executive director of the VCAA. We're going to start on time as we did last time. Arden, thank you very much for delivering this session today. I'm going to transfer the host to you right now.
Okay.
There you go.
All right, let me just share my screen so we can get everything up here.
And I should also mention that we have Evan and National from the U of A VCPE Student Club who are helping us organize this speaker series. So I want to thank them again, and they're going to be coordinating the Q&A today as well.
Awesome. All right, well, we might as well get things going. Looks like the participants are starting to kind of pile in, and just for everybody's benefit, maybe I should talk a little bit about who you're talking, who's presenting this, where I'm coming from. Yeah, so my name is Arden. I am a investment manager with Yaletown Partners, a venture capital firm here in Canada based in Vancouver, as the name implies. And Yaletown's been around for about 20 years. So, the company's been in the venture capital game for a while. I myself have been in venture for about 4 years now, but spent most of that time, the last 2 decades or so, in capital markets. You could say I'm a finance and investment guy, from commercial real estate to public equities. I've pretty much spent my career representing investors from private individuals all the way to government, essentially taxpayers, as well as pension funds and at the institutional level. And so for those of you who saw Pat Lohr's talk last week, I was there. And I think the really interesting thing about venture capital is that it's one of the few financial professions where there's so many different places we all come from. It's not like you go get your CFA, you do your finance degree, and then you go work in a shop investing. Venture has such a wide range and diversity of people. I think that's what makes it really interesting. So you get guys like Pat who were very successful entrepreneurs and have an incredibly intimate knowledge of operations. You get people like myself who come from a capital markets and investment background who look at things from more of a macro level sometimes. And so I think there's something to learn from everybody. And the important thing is that as the audience, I'm assuming everybody here is learning to be an investor, kind of develop your own perspective of the world, your own view and your own way of looking at investment. I think we always used to say in one of the places I worked, investing is like religion. Everybody has their own version or take of it. You're right if you make money. So with that, that's kind of where I'm coming from in talking about due diligence today. Pat gave a very high level overview of the industry itself. And what I'm aiming to do is take you down the next part of the funnel and talk about, okay, what do you do once you've decided to make an investment? So due diligence, the definition is up there for you to see. That's the slides here. Why do you want to do it? Well, I think there's some very salient news out there, and it has been for a number of years, about what happens when you don't do your due diligence properly. As recently as the last few months, what happened with FTX, what happened with Theranos a couple of years ago. If you are a professional investor and you are representing someone else's money, you have a fiduciary duty to make sure you are taking care of that. Right? You have to make sure that you are doing your homework. And not to say that due diligence is a guarantee of anything, but you have to actually show that you did some research and you have some idea of the risks that were involved and why you got it and the reasons for investing in the first place. So let's get started. And the first part of any due diligence process, essentially doing your homework, is information gathering. Well, how do you get there? Obviously, the first thing is companies come across your radar in many ways. It's not like in public equities where you're looking at companies that are already listed on the stock market, or for example, in real estate, where you're looking at listings or properties that are out there existing. Private companies, startups, essentially at the early stage, remember we're focused on early stage here, they can come to you. You can find them at pitch competitions. It might just be through someone you know, but there's so many different ways that an entrepreneur can come across your way. And your job is to evaluate them and figure out whether or not you want to move forward. And you essentially start with what we call an investment thesis. And without getting too detailed into it, really, remember I said earlier, as an investor, your job is to have a perspective of the world. Where do you find value? What do you see as important? And so it's like a theme, right, for a fund. So for example, with Accelerate Fund, which I manage on behalf of Yaletown Partners, we look for early stage companies that have some beginning revenue, typically in software, and who have not raised a Series A yet. So there's some initial qualifying requirements that we put in there, and it kind of helps you narrow down the universe, because you can't even as a generalist investor, you can't chase down everything, right? You cannot go out there and invest in every possible company out there. You need to have a framework and a lens to start with, at the very least. So establishing those basic criteria are important. And that's how you kind of start filtering all those, because some funds, we'll see 10, 15, 20 pitches a week. Pat, I think he noted a number, but we see a lot of companies, especially the further out you go. Like Accelerate Fund only invests in Alberta-based companies, and we still see a good number. But once you start expanding that scope, let's say you're able to go across Canada, North America, you have to have a way of filtering it out. And there is a process, right? Generally, funds, if you're an individual investor, you can do whatever you like. You can invest based on the fact that you like where this founder came from. You went to the same school, you worked in that sector, or you simply, like the cut of their jib, so to speak. But in a fund, there's actually a process where, again, when I talked about that funnel earlier, you start with a company, you run it through a bunch of filters, and then you kind of take it through a formal process before you come to a final decision. So, for example, Accelerate Fund, what we'll do is we'll look at the applicants, so we'll look at someone out there and say, is there an opportunity here? Do we think it's going to fit? Is the size of the round they're raising, suitable for our investment thesis? And then if our team decides, okay, or one of us decides, it's worth a discussion, we might call up or talk to the entrepreneur, or take a meeting and have an initial discussion. Now, for some investors, that's a pitch. We'll actually ask them to pitch us. I think for us, we typically like to just have a conversation, 30 minutes, get an introduction to the entrepreneur and just get to know them. It's important to us to understand where the entrepreneur came from, what motivated them, what their background is. And if we feel that the basics are there, then we'll likely have them then do a full pitch, and we'll schedule an hour to the entire team. And so the team then makes a decision on whether or not we go forward with due diligence. And then we get through that due diligence process, which typically, I would say on average, takes about 30 days, up 30 days. And then we bring it before an investment committee, which ensures that other people who are not involved in the day-to-day get to see what we're doing, and we have to make a business case for them. So we're actually, as investors, repitching and selling the idea of that startup. So if I don't feel that I can sell you to my investment committee, right, as an investor, chances are I'm not going to want to take this through due diligence. So I have to be confident as an investor that I can actually put this through and get approved. And the way you do that is your due diligence. So first things first, a data room, right? As an investor, you want to ask the entrepreneur for access to a data room. And it can look as simple as something like Google Drive, Dropbox. It doesn't have to be anything fancy, but the idea is to have everything organized in one place so that it avoids having multiple back and forths with lots of emails, saves you time. so because you can, as an entrepreneur, if you have a team, so you're not having to email stuff back and forth with each other. And for the entrepreneur, they can have one data room that they can share with multiple investors. Again, instead of constantly emailing stuff back and forth and having to ask for stuff, it's important to make this a time efficient process, because a lot of the times, entrepreneurs, it's respecting their time. They're incredibly busy people building their companies. And the last thing you want to do is be peppering them with emails and questions every 10, 15 minutes for the next 30 days. So the idea is, hopefully, and I've seen, I don't see a lot of companies that are raising money that don't have a data room. And I think, maybe I'll credit that to the fact that the ecosystem has matured, and there's more entrepreneurs, and there's more training, and there's more talk and education out there about how to prepare for investment. So we don't see as many companies now that don't have a data room or haven't assembled one yet by the time they've talked to investors. And so what I'm providing here, and we'll use this and come back to this throughout the presentation, but this is the actual checklist that we use at Yaletown for the Accelerate Fund. And not everything will necessarily be applicable, and this presentation will be available later on via link. But the point is, this helps us keep organized, and what we'll do is we can send this checklist to the entrepreneur and say, this is the information we're looking for. We'll figure out what's applicable and what's not. And that way we know we've covered everything and been thorough about it. Again, it's a process. All right, so you've got all the information, right? What do you do with it? And there's a couple of, I would say, in my experience, primary things. One, you're looking to verify the information given to you by the company. So the entrepreneur is pitching you. The entrepreneur is telling you something about the market. They're telling you something about their company. They're telling you something about a technology. And you don't just take what's in the pitch deck and then regurgitate it to your investment committee. I mean, you use parts of it, sure, that's fine. But what's important is you actually go back and verify that out in the market. So, for example, if an entrepreneur says, we think this market size is X, right? Our total addressable market, or we think this is how big it is, or what we're going after, there are sources you can go after as an analyst or as an investment professional to verify that. Make sure you're in the same kind of order of magnitude. I mean, recently we're doing due diligence on a company. It's a medical device company, and they gave us their calculations because it's kind of a new blue ocean territory where it's not really known how big the market is, but they gave us their calculations based on certain information that they gathered, kind of using an adjacent market. They came out to a number. It was like 12 billion for their total addressable market for this one business line. And we independently went and looked for similar information and ran our own calculations from the bottom up. And we came up with a number that was around 10 billion. So we know that the order of magnitude is close. And that's really all it is. It's not meant to be an exact science, but you're looking to verify what they gave you and not just take it for granted or take their word for it. And then you have to put together a narrative, right? A business case that supports your conviction. Now, the thing about this is it's a bit of art and it's a bit of science. It's a bit of understanding, okay, what kind of business are we looking at? What are the indicators of success? Remember what I talked about earlier on about developing your own perspective of the world. Part of that is figuring out where you're going to specialize. And so you understand what the drivers of value are. So what I mean is, if you are investing in a software as a service company, right? It doesn't matter what industry. Generally, there are certain things you're going to be interested in if they're in revenue. You're going to be looking for growth rate. You're going to be looking for margins. You're going to be looking for certain metrics that give you an indication, because we've seen so many companies in the past, and we have an idea of what kind of metrics matter and at what stage. If you are looking to invest in a life sciences company, there's not going to be a lot of revenue at all. There's going to be a heavy R&D component where they're raising a lot of money, and it's going to be likely a very binary outcome. Either this thing is going to hit it and everybody's going to get rich, or it's going to go nowhere. So you'll have to look at and understand, what milestones are we looking at? What has the company done to de-risk those milestones? So again, it comes down to understanding what's the story that you need to tell and the business case that you need to create that supports that decision to say, yes, we think the risk is worth investing. So over time, like I mentioned, everybody has their own process, right? And how you put together that information, how, Pat and the guys at Panache or the people at Graphite or Yaletown, how we organize and do our due diligence, even between partners and people within the same firm, will vary because everybody kind of learns and assembles information and puts together business cases in their own way. So an example of a process might be, like for me, I like to take all the information and take some notes and read. I don't start writing a memo or anything just yet. What I essentially do is I'm trying to understand all the data points so that I can start seeing patterns and coming up with narrative inside my head. I'll pull third-party information like market reports and look at any sort of customer calls they may have or industry articles, and use that to start triangulating on, okay, I see where this is going. I see what kind of story I can tell and how I can back it up with some data and some information. Whether that data is qualitative, for example, and that might just be this company's pre-revenue, but they've got about a dozen customers that have given some really great feedback. And you can use that to back up the proposition. Once I've spent some time connecting the dots and understanding what the story needs to be, then that's when, at that point, I will actually start sketching and outlining a story, right, and writing it out. This is no different. It's exactly like building a business case in school, for those of you who have done it. But that's what you're putting together here in order to pitch to your investment committee. And of course, the final part is putting pen to paper and putting the investment memo together. And if we have time, I actually have a mock investment committee memo presentation that I will run through with everybody once we're done the presentation, just so you can see where all that information goes and how it gets presented for us anyhow. Again, not every company and every firm does it the same way. What I'm hoping to show you is just one way that we do it and to give you some idea of how to get started. What we're going to go into quickly here are just some high-level ways to organize your thoughts, right? I mean, I can't stress enough, being organized is really important in doing your due diligence because what you're trying to do is build a case. The first thing we'll cover, I mean, the major area, there's three major areas and some other smaller, minor ones. So the three big ones you'll hear often that investors think about, especially in early stage, are team, technology, and market. And different investors, again, we're all people and we have different perspectives and backgrounds. We will value each differently. Some will put a heavier emphasis on tech. Some people place a heavy emphasis on the market. And some, especially early stage, say team is everything because the business and the tech may change down the road. It's a great team that'll be able to navigate through. So again, you as an investor have to figure out for yourself, what do you think makes the most difference and what's important to you for the stage and type of company you're investing in. So what's behind the solution, right? It's important to understand the technology and how it creates an edge for the company, because what are we looking to do here? Let's not forget, at the end of the day, this is not philanthropy. We as investors, the first question you should be asking yourself, how do I make a return on this investment? And part of that is understanding what the asset's edge is. And it doesn't matter what asset class you're investing in, what you're trying to do is figure out, where does this company have an advantage over others? How does this asset stand a chance of generating a higher return, or at least succeeding anyhow, in especially for venture, in growing and generating the kind of return that we need? And part of that is if you're in venture, you're likely investing in technology. So is it artificial intelligence? Is it a medical device? Is it some sort of new therapy? It's important to have at least a high level understanding of the technology, what it does, how it operates, and the advantage it confers upon the entrepreneur. Now, intellectual property is something that everybody associates with technology, and it is important, but it's not always important, right? I mean, what is IP? I mean, really, these it's the all the documentation and evidence, right? That this first, where it says all the employees and founders agree the IP belongs to the company. That is really an assignment agreement. So, for example, you'll have, for example, a team that's done a lot of research at a university, and they have decided that they want to create a company out of it. That's where they will agree that they'll write an assignment basically saying, okay, the stuff that we developed here at the university now belongs to the company, right? So it's important because that's an asset. and that could be worth something. You don't want someone to be able to walk away with that, and then the company doesn't have a right to use that intellectual property anymore. And it can be patents, copyrights, trademarks, and such. What's more important, though, generally, is the strategy. Okay, intellectual property and technology, arguably in and of itself, doesn't have any value. Okay, it's how you apply that intellectual property that has value. So, and there are actually firms, especially if you have deep tech, that will work with that you can work with, that will work with the entrepreneur in order to come up with an intellectual property strategy. So it could be something like, we're going to register this in Europe. We're not going to develop there right now, but what this does is it prevents certain companies there where this industry is starting to grow from developing this stuff ahead of us, so that we get a chance to develop out the North American market first, right? That might be an example of a strategy. So it's important to understand, if they have that going on, what that strategy is and how that plays into the growth of their company. So like I said, IP isn't always necessary, but when it, or applicable, but when it is, there are reasons why it's important to us. As I said, you don't want someone to be able to walk away with the secret sauce at the edge that the company might have, because it could, lead to things like, as noted here, loss of income, devaluation of the asset. It's important to make sure that that's all, set and tight. Again, sometimes it's just trade secrets, and sometimes it's a speed to market play. But your job as an investor is to understand that and then be able to characterize the risk involved. So again, I said we come back to this example checklist. I'll show you kind of like, this is where we cover this, right? And so it's a very pragmatic application of a checklist. So under technology and product, we try to look for things like customer use cases. We'll talk to customers themselves. We'll actually do a call. What's the competitive positioning, what the roadmap is like. These are all things that we're going to want to examine. We might want to look at, okay, what patents have been filed, right? What are there any disputes? Are there any lawsuits? That sort of thing. All right, on to team, right? I mean, I think everybody knows, like, the important thing is we're investing in people when it comes to venture, and quite frankly, any sort of venture. I think one thing I've learned over time, and I've heard from other far more experienced investors than I am, is that finance is people. At the end of the day, you can do all the pro formas and all the business analysis you want, and you can be a spreadsheet wizard. But if you can't take that information and turn it into a story, a narrative that motivates someone to do something with it, then it's really all for naught. And it's the same thing with the venture. It's important to have a team that can take that, invention and turn it into a business. I mean, this is really where understanding the difference between innovation and entrepreneurship is important, right? Because innovation is the creation of something new, and that's something that people do every day in labs, in school, in just sitting under a tree. But entrepreneurship is turning that innovation into a business, and that has to be done by people. And so it's important to understand the team behind the venture you're looking to invest in. So I thought I'd outline a few things and quickly go over something that may be important and how you can find out, right? Things we think about are, solo versus co-founders. Solo founders have a hard time, often because they don't have someone else to bounce stuff off of. And that's okay if they have a good team around them that can complement their strengths. Co-founders, if it's a team, we're always interested in how they meet. What have they done together? Are they battle tested? There's a difference between two co-founders who have worked together for a long time and two who just met at some startup camp. Have they been through ups and downs? Because everything's great when there's no money on the table and everything's going well, and everybody's full of idealism and optimism. But quite frankly, when things go south, that's when you find out if you've got a good partner or not. Do they have any experience as an entrepreneur? Have they had an exit? What kind of exit was it? What lessons did they learn? Those are always important, because there is a certain degree of pattern matching that and understanding how difficult it will be in growing and exiting a company. And so somebody who's had that experience, certainly that counts. Do they have industry or technical experience? I've always said I will never invest in a team of MBAs that have no technical or industry background. because you can find lots of MBAs to surround the technical founders with. Coming back to what the edge is, it's somebody, this is typically how an entrepreneur has an edge, is they have such a deep appreciation and understanding of an industry or a technology because they worked on it, they did a PhD on it, or they spent 10, 15, 20 years in an industry. They know the problems inside out. They know how to talk to the customers in the industry, or they have some sort of, I guess, what you'd call asymmetrical knowledge of what's going on in their company that others don't. Business experience is important. Again, I mentioned, right, the difference between innovation and entrepreneurship. But the thing is, we can, if they don't have a lot, that's okay. Are they coachable enough to be able to say, hey, if we help you, if we help them and bring in business people, because part of our job as investors, as venture capital investors, is having a network, right? That's one of the greatest values most venture investors bring because we're out, that's part of our job. In fact, I often joke that my part-time job is as a recruiter, because what we do is we put people together with companies where there is that business need. Again, I mentioned coachability. You know, there's some other factors involved here. What they need to have, obviously have vision. I think Pat mentioned last week that resilience was the one thing he looks for. You know, do they have founder magic? Whatever that magic is, you have to figure out what that means for you. Because again, I said it before, it's everyone's different, and what another investor thinks is magic, I might look at that as a Achilles heel. And also alignments and incentives. And I'll go into this a little bit more later in the cap table and compensation discussion. But you know, basically the question is, are they motivated and incentivized to grow this company in the direction and the kind of way that we need as an investor? Is there a match there? A famous public equity investor, Charlie Munger, who is Warren Buffett's partner, has always said, show me the incentives and I'll show you the outcome. And that is always a truism because, again, it comes down to people. And I'll explain more about that. We'll go further into that in the next few slides. And current future needs of the company, right? Like you have certain skills now. So for example, you've got a medical technology company and it's full of really bright technical people and people who have just incredible scientific credentials. And that's what's needed right now because we have to get through clinical trials and to be able to validate and get regulatory approval for this device, for example. But the next step after that is to commercialize. And you're going to need people that understand how to do sales, that understand how to do business development. There's no use having them on the team right now, but knowing that once we get these approvals, we're going to need those people. It's making sure that the entrepreneur understands that and there's a plan in place. And so what have they done? Is it, you know, maybe they have at least an advisor or a board director that has some experience in the area or some networks. But it's important to think about current and future needs and that the entrepreneur is thinking about and understands that. And a few different ways that you can find out, right? I mean, talk to them, right? This is a big part of, you know, this isn't, you know, a case where we just hear a pitch and we go off and then we, you know, do some research and go, yes, we want to invest. In fact, sometimes it's better if the due diligence process takes longer or there's bumps along the road. I've had a couple of deals where that was the case, and it really gives you some insight into how the entrepreneur operates under pressure. It gives you some insight into how they communicate and how they deal with adversity. Is if you're going, for example, you're trying to get through getting a deal done, and suddenly you find something in the shareholder agreement that does not work and is a deal killer, and you have to negotiate around that, and then they have to deal with their board. There's all kinds of dynamics at play here. How well does the entrepreneur handle that? You know, do they find a way to push forward, or do they huff and puff and throw their hands in the air and say this is a waste of time? It's a really good test. So spend time with the entrepreneur and talk to them, and you get to, you know, characterize their behavior. And there's that always the story of how, you know, you can read this in a number of interviews where CEOs or people we're hiring like to take out the candidate for lunch and see how they treat the serving staff, because that is an indicator of how they'll treat people, right? So don't be afraid to talk to the entrepreneur, see them under different circumstances, sit in on a meeting, whatever you need to evaluate their behavior. You can do reference calls. That's always a good one. We always do reference calls. Look at the org charts to see if they understand the current and future needs of the company. Talk to their board and their advisors and check out what the makeup of the board and advisors are. Are they just all investors from before and none of them have any real experience in the area? Or has the entrepreneur really cultivated a board where he's got world-class people from that industry that can help him grow? Look at the cap table. How much does each founder own? So for example, if you've got, we had one case where we looked at a company that was looking interesting. We wanted to invest in them. And once we looked at the cap table, we saw that, it was two founders, essentially. One founder had pretty much 90% ownership of the shares, and the other one had 5%, and the rest were in options. But the one that had 5% was the CEO, was doing all of the main day-to-day operations and had put in more money into the company than the other founder. And every time we tried to get at the heart of it, the main founder, who owned a bigger chunk of the company, never really would give us a straight answer, because when we said we'd like to make sure that the CEO has an appropriate level of ownership in the company, so that they're incentivized to take this thing all the way and to not feel any sort of resentment over the workload. The answers we kept getting was, well, we want everybody to be, we want everyone to be well compensated, and we just couldn't get a straight answer. And in the end, we just didn't feel that that was the right kind of alignment, and it wouldn't be fair. And it wasn't a situation that we were comfortable with, so we passed, right? But the cap table was what really illustrated to us, and we wouldn't have known until we looked into how much ownership they had. Compensation is important. Are they paying themselves at, below, or above market? And as an investor, you have to decide for yourself, what do you think is reasonable? There's market data out there, right, and comparables you can look at. But I've worked with other investors who felt like they shouldn't pay themselves anything more than $40,000 a year. They need to be hungry and scraping by. Others who have a belief that no, you need to be able to make sure that your bills are paid and you're not stressed out, so that you can focus on the business and not feeding yourselves. And we've seen cases where entrepreneurs have been paying themselves way above market, and it's a huge drain on cash. So it's important to understand the compensation, and they should be showing you their compensation tables. And so again, in our checklist, we'll look for org charts. We'll do a review of the management and directors and advisors, look at the comp, any sort of stock option agreements, payroll, anything to do with the compensation structure. Now onto market. This is a quote from a prolific and influential investor, the late Don Valentine, founder of Sequoia Capital, one of the, if you call it, I guess you'd call OG venture capital firms out of the Valley, one of the original investors in Atari, as well as Apple. And Don really believed, his big emphasis was, I don't care about the team. You can always replace people. I'm paraphrasing here, but his emphasis was, you have to have a big market. If you're going to build a massive company, you got to go after a massive market. And that was his philosophy, right? And again, everyone's different, but it certainly makes sense. And what it comes down to when you're doing a market analysis, it's business 101, right? There's some important things to understand. The market size, this is the big one. Like we just talked about market size, right? Is it big enough? And I won't go into the venture style growth because Pat went into that last week. And the point is, not every company is, even in tech, is suitable for venture capital, right? Not every company is going to grow at that, it's going to show that kind of growth rate, the super linear growth rate, and not every company should. So here's a note, though, it's interesting, is it's not always possible to determine, especially at the early stage, right, how big the market actually is, especially if it's what we call a blue ocean concept, where it's brand new, it's novel, it's not an area that's been tackled before. And so one of my favorite examples of this was Uber, right? And several years ago, so back when I was in public equities, there's a NYU prof named Aswath Damodaran, and he's really famous amongst public equity investors. And he basically came out and gave Uber a valuation and said that, I think the total market is really the taxi market. It's about 100 billion, right? And so he was very bearish on Uber's growth, but this is how he proxied the market. Well, Bill Gurley, who at Benchmark Capital and was a Series A investor, so this is back in 2014 or so. He put out this, really interesting analysis of how he thought Damodaran totally missed the mark because he didn't take into account a bunch of stuff like price elasticity, different uses. So it's not just taxis. It's use in less urban areas where taxis don't make sense. It's the rental car market. It's short trips. It's transporting kids or alternatives for seniors. It's mass transit supplement. So, for example, if you miss the train because of the convenience and price of Uber, you would take that instead. And also another big one is an alternative to car ownership. And so, that was how Bill was looking at the market, and he sized it much, much higher. And the interesting thing is we have the benefit of time now and looking back. And what Professor Damodaran said was, he figured $100 billion market, and that, the best Uber would do is like a 10% penetration rate, right? So that predicts what, a $10 billion kind of maximum revenue for Uber. Well, when you look at last year, Uber's revenue was about 30 billion. And it really did substitute for a lot of the things that Bill had said. So it's interesting to, while market sizing is, especially an early stage venture, is important, also understand that it could be, especially for really disruptive technology, adjacent spaces and different uses that you haven't accounted for. Thinking about what the trend is happening in the world, right? The aging population certainly makes a lot of life science and medical technologies important. It could be digitization. It could be the hybrid work world now. Like, what is the major trend going on that this company is going to be riding on that creates an opportunity for them, right? Want to look at the competitive environment, right? And there's no such thing as no competition. If you ask an entrepreneur, what's the competition? And they say nobody, then they really haven't thought about it, because status quo and doing nothing, right, is absolutely not an alternative. One of the questions we ask customers when we're talking to them in our customer interviews is, what made you decide to move on from the status quo? What got you to do something different and adopt this solution? So that is important to understand. I'll take a quick second here to talk about my pet peeve of the classic competition slide, where it's a grid, and then the entrepreneur is somehow in the top right all the time. And the first question I ask myself is, did you just make up those two factors so that you wind up on the top right-hand side? How do you know that those things are important to your customer? So if you can come to me and say, we spoke to 100 different clients, and they said these are the things that are important to them and where we stand out amongst others, now I can believe that it's a competitive advantage. All right. And they need to understand who their target customer is, right? And how is the company going to reach them? A spotlight on a material, a business plan is important, because, you'll see a pitch, and not all companies have them. But what you're looking for, if they have it, is a much more deeper dive and detailed look into the business itself, right? That certainly helps. So be sure to ask for it. So again, from our checklist, here's a bunch of things that we'll look for and ask for in order to ascertain the market. Tying up for some really quickly, some stuff on the back end here. I always say with legal, trust is good, paper is best. Is the company for real? So you're going to want to be verifying that they are, and you do that through the minute book generally, or we have our legal counsel come in and do the legal due diligence portion of it. And what they're looking for are things like a certificate of incorporation, bylaws, just basically everything saying this company is who they say they are, and they're doing things appropriately by the book, so to speak. And a shareholder agreement is an important one, because a shareholder agreement really governs how you get in and get out of a company as an owner, and that could impact you as an investor. So there's a lot of things to understand there. Financials, they definitely are important. They tell a story, right? Especially historical. What it does is you can kind of get a sense of, the quality of earnings, seasonality. Does the entrepreneur understand, have a good sense of their expenses and their revenues? What have they spent it on? And looking forward in their projections, it is a simple forecast, but it gives you a sense of, are they realistic about where the company is going, right? And how big the market potential might be. And again, you don't need 5, 8, 10 years out in the future, because the further anything past year one is really a guess, but it really is an insight into how well the entrepreneur understands their business and how realistic they think it's going to be, or you think it will be. So, for example, if they tell you, well, in year two, we're going to be expanding with offices internationally, and then you look in their budget and they've got $3,000 budgeted for travel, there might be a bit of a disconnect there, right? I talk about what I like to do is look at the year one revenue plan. And what that really means is, year one, like from when you invest in the next year, you can actually break down the sales, right? If you understand, for example, the math of how many customers you need to call, at times, how much revenue each customer is worth, you can kind of start building a sense of, okay, this is realistic. If you have to talk to 1,000 customers next year and you're the only one as the founder doing the sales, that might be questionable. So it's a bit of a reality check. And again, this is just a good litmus test to see if the range of possibilities, right? It's not meant to be precise. You're not going to hold them to it necessarily, but you really do want to get a sense of what's the order of magnitude this company can go to. The cap table, again, this is where you get to see how what the makeup of ownership is, right? And it's important because it really represents all of the activities involved in the ownership of the company. And you as an investor need this in order to model current and future rounds of financing, right? You will do an exit analysis where you look at, okay, if we buy in for this much, we get this percentage of the company. What does that mean for us at a time when it exits? How much do we think we can make, right? Because remember, you have to really understand, how am I going to make a return and what does that return look like? And the nice thing is when you have a tool like this, you can use it to model things like the entrepreneur says, well, I'd like a higher valuation. Or it might be, we want to raise more money. What does that mean? How does that dilute our position? As an interesting story, one of our portfolio companies in Accelerate Fund 2, I used this tool where the entrepreneur was thinking about they wanted like another $1 million in their valuation. And in the end, I modeled it for him and showed him that the dilution actually didn't really matter that much, wouldn't make a difference, but it would make a difference for the investors. And so we were able to come to a reasonable agreement on what the valuation would be. So this is probably the most complex math and important math you'll do as an early stage investor, right? And so again, all the things I talked about here, there are implications, right? You might want to understand, for example, if there's prior investors, what kind of shares do they have? If they're pref shares and you're now buying common shares, in the case of a sale or some sort of bankruptcy event, your capital sits behind in priority to the others. So it's understanding your liquidity ranking dilution. Is there debt in place that takes priority over you? Who are the other investors? Are they the investors in this round? Are they able to bring in more money next round? If the company suddenly needs, let's just say a pandemic hits and the company needs to bolster their cash reserves, are the investors around the table able to pony up, or are you the only fund in there that has, that's going to have to take on all the risk? And again, making sure the interests are aligned. As the story I mentioned earlier before, if we see that a founder doesn't have enough ownership, we do question if they're going to be motivated to take it all the way to the end. Pricing an early stage round, let's just briefly touch on this. There's not a lot of magic to it, and it's not an exact science, but it really doesn't have anything to do with the value of the company, especially if they're earning revenue under $1 million, right? It comes down to supply and demand, how much the entrepreneur needs and wants to sell of the company, and how much the investor needs for their investment in terms of ownership. And there are tools that investors can use to mitigate that. For example, ratchets, which is an anti-dilution clause, which basically protects you from losing money, right, in the next round. Like say if you buy into the company now at $10 million, what you're trying to do, hopefully, and as a venture investor, is increase, hopefully, the next raise, because that's how we validate the price of a company, other than an exit, is going to be at least $20 to $30 million in value. But if the company doesn't perform, and let's say they have to raise at a much lower, even down round, right? We'll call that, which is less than 10 million. then there can be mechanisms in place that instantly give the investor more shares to protect their percentage ownership position, right? And so that when the exit eventually comes, you still get the percentage you need. And really, the valuation of this round is influenced by what you think the valuation of the next round will be. So remember when I said, okay, I'm looking at the next round. If I'm investing now and the entrepreneur wants a $5 million valuation, I have to be convinced that by the time they get to the next raise, the company can be worth somewhere between 10 to 15 million. And that takes a bit of an exercise in understanding their sales and their projections, how the market will evaluate this type of business model. So if it's software as a service, what do you think the multiples are going to be? And that has a bit of an influence, a lot of influence, quite frankly, on how much we'll pay at this stage. And again, yeah, the terms, all the terms I just talked about, they affect the riskiness of your investment. There's a number of factors beyond price, and I think rather than get into it, Elizabeth Yin, who's an early stage venture investor and co-founder of Hustle Fund out of the Valley, she's got a great Twitter thread about early stage valuation. And when you get the copy of this presentation, you can click on it. Highly recommend following her. She tweets prolifically and makes a lot of sense. She's a very great source to learn from for early stage investing. Okay, and this, Craig is going to go into this next week in terms of structuring a venture deal. But, really, it just comes down to how are you getting into the company? What kind of rights you get? What is the form? Is it equity? Is it some sort of convertible debt, which is a loan that you're making that will eventually convert into shares? They all have different kinds of risks associated with them. A few odds and ends. Really, it comes down. We have a list, but anything you need to feel comfortable, right? With the risk reward ratio, you should ask for. And it might be a tour of the facility. It might be talking to their staff. It might be a demo of the tech. Whatever it is you feel you need to put your case together. As a professional investor, we have a duty, right, to look after the interests of our investors' capital, limited partners, they're our clients. And so you've got to maintain this balance between being conservative and being aggressive, because if you're too conservative, you could miss out on an opportunity and miss out on upside. If you're too aggressive, you might take on too much risk and wind up losing all the capital. And there's no right or wrong or easy answer to this. That's your job as an investor, as a fund, to figure out where you sit on that spectrum, right? And so you'll see in the presentation, like I said, these are the kind of things we ask for to ascertain all the information I just talked about. So rounding it out, putting it all together, right? Due diligence is really a fact-finding mission, right? That's either going to support or disqualify their suitability for investment. You're looking for flags, green flags, red flags, risks. What's the possible reward? How real is this? Where do we see the potential? And what do you have to back that up? End result is usually, you'll have an investment memo, something on paper, right? A case that goes to an investment committee. And ultimately, investors are people, right? And so each fund or individual looks at things in their own way. Remember I mentioned red flags before and green flags? Well, what one investor sees as a red or green flag, another might not see the same way. And so you have to understand that for yourself. Risk can often be a subjective thing. And not to say that anything goes, there's general parameters out there, but I don't want you to get the impression that there is a absolute, kind of a cutoff for everything, a definition out there. If there was, every investor would make the same investments and generate the same return, right? And like I said, it's important to learn from others, but if you really want to be an investor, get out there. And the only way to become good at this is to actually invest. Develop the mileage and develop your own view on what it means to find value, where value comes from. And, that might mean putting some of your own money in as an angel investor. It might just mean following companies and their progress and coming up with your own thesis on them and seeing if you are right or wrong. If you look, the nice public equities are, you can easily build a practice portfolio and monitor companies and see if you were right or wrong. That's a beautiful thing about investment. Either you make money or you don't. There's no hiding behind it. And having an investment thesis and a framework and a disciplined process, it's not a guarantee of success, but what it does is it gives you discipline and allows you to look back and say, okay, where did I go wrong? What did I have to adjust? How do I, you can rationalize how you make decisions. As a professional venture investor, if you're part of a fund, a general partner, and you're looking to raise money from limited partners, you're not going to convince them to invest with you by saying, I'm really good at picking winners. You need to show them that you have a disciplined process and you understand that, right? And so I will, leave you with this quote: never discount the role that timing and luck play in success. Investing is a game of risk versus reward, and understanding the risk doesn't mean you get rid of them, but it does mean you make informed decisions. And, that being said, someone can make a lucky guess and make a lot of money. Those people are few and far between. It is more of an art than a science. There's no guarantees, right? As everyone interprets risk differently in early stage investing, even later stage. And there's a lot of external factors that can impact any asset class at any stage. But if you consider diligence as creating a foundation to capitalize on luck and increase your odds of success, I think that's a good way to look at it. And you need to decide for yourselves, what kind of investor or capital manager do you want to be? And that, wow, that runs almost an hour, but that is the presentation itself. And what I will do is, if anybody's interested in seeing quickly what an investment memo looks like, I'd be happy to do that in overtime if anybody wants to stick around. But from there, I'm happy to take questions. I see there's a bunch here. Okay. All right, let's start with the Q&A. There's only one, so I'll start with that. Is there a ratchet from founders' side where founders gets initial investment increase? We usually don't see that. That's kind of like the reverse anti-dilution clause. I personally have never seen that. Not to say it couldn't exist, but remember, everything is a negotiation, right? So if you can convince your investors as an entrepreneur to give you that, if you look at Google and you look at Facebook, these companies where the power balance was with the entrepreneurs, they were able to negotiate, super voting rights and have all kinds of stuff that most entrepreneurs couldn't get. And just looking through the chat. Oh, there we go. Thanks, George. That is exactly the article. Great. And okay, these aren't questions, but thank you, George. The Twitter thread.
Hey, Arden, it looks like we got a live question from Michael.
Oh, yes. Okay, please. Let's go to live questions. And if you type one in, just put your hand up. It'll be easier to actually just, do a question and answer than to look through the comments.
Arden, thanks for your time. I appreciate it this evening. I just had a question about sort of relevance of the original business case. When you're looking at an investment, are you considering a requirement that a startup may have to pivot or change some of the markets that it goes after? Or are you basically, with due diligence, you're just looking at, is the proposed case going to work? Are you considering sort of backup options at that point?
Well, it's really hard to, if we could anticipate all the backup options, we'd see the future. I think the thing is, you are assessing the risk at this stage, but one thing we do look at is optionality. And it is that question of, okay, right, what other markets, where else can this technology go? And that plays a factor in whether or not we would invest, because it is a case of, well, okay, we think that we had one company, for example, that we invested in a couple of years ago that had about 3 or 4 different product lines, and they were focused on product line one first. But we knew that if they developed the other ones out, these would help manage to diversify the risk and the revenues. It was just a matter of timing. The pandemic hit, and suddenly the priorities changed, but they found that another one of their products had far more traction and appeal because of the pandemic. So they went after that. So that play on optionality really played out, right? So yeah, you do want to look at the possibilities, you accept the fact that at this stage, anything can happen. They could change, right? And it often does.
Was that something that they had presented to you when they made their original proposal, as in, this is our focus, but here are some other things? Or
yeah, oh yeah, absolutely. That's why it's important to understand the suite of products and the roadmap, because you as an investor have to make a call on, okay, if things went south, what else could we do with this? Now, the entrepreneur might not be thinking that, and that might be your value add, or you might actually get in a conversation and say, what do you think of this? If this happened, what you want to understand is, how is the entrepreneur thinking about it, right? And if he can see what you can see, or she can see what you can see, that's certainly a positive thing. So optionality is a way to manage risk.
That balance between having a founder who's dedicated and so like a true believer, basically, and somebody who's more logical and maybe seeing those options, I guess.
I would agree with that. I mean, I think it comes down to what are they dogmatic about? If they're dogmatic about a particular way to solve a problem, that's different than being dogmatic about solving a certain problem, the problem they're trying to solve, right? So yeah, I mean, that's a case by case call.
Good, thank you, appreciate it.
Thanks for the question, Michael. Anyone else with a hand?
It looks like we got a couple in the chat now. We're going back and forth.
Okay, all right, no worries, no worries. Okay. Yeah, I can absolutely, if everybody would like, okay, quickly for Niall's question, thoughts on investing in first-time founders versus founders in their second venture onwards. The fact is, I think there's a lot of, while I mentioned that, there are some points for having a second venture, it's not a guarantee, and I don't think for myself personally, that's not entirely the whole focus, right? It's not like, well, I mean, it depends. If you found a Google and you exited and you're starting something else, but how many of those do we come across? I think what matters is what the vision and the market is. I'm a big believer in the market, right? For me, that's, I talked about how we all have our own views. Like I have to believe there's a big market you're going after, because then you have lots of room to play. So if you're a first-time founder, second-time founder, as long as you're coachable and can learn along the way, it has some influence for myself personally, but there are other factors that I find are important. But again, there are other investors I know, even some I work with, who, if you are a serial entrepreneur right away, that gets you, in. You're like, doesn't matter, we'll give them the valuation, we're in, right? So, and if you're interested, I'd be happy to just run through really quickly the investment committee example I've got. Hang on a second here. So you can see where and how all this information comes into play. I'm just loading it up. And for those of you that do have to go, thank you so much for attending. It is 6 p.m. now after a long work day on a Thursday, and I certainly appreciate your attention in coming here. I actually had to redo this presentation last weekend because I realized the presentation I normally use is geared towards entrepreneurs. And I wanted to make sure that this came from the perspective of for an investor. Okay, so I'm going to run through this, and what I'll do is, I mean, the details aren't as important as I'm just kind of getting a sense of the form of it, because I do want to respect everybody's time here. So this is what an actual investment approval request looks like for our fund, right? Thank you, James. And so this is kind of a semi-fictional company. And we have an entire, and so our investment memo, I guess, format really is influenced by my experience working in institutions. I spent 4 years at Aimco, another year at a wealth manager, and I'm in those areas of finance is where I really cut my teeth in understanding how to put a bit together an investment memo and business case. Not every firm or every fund will look like this. Some of them are just 1 or 2 pagers. Some of them are even more detailed. So this is just meant to be an example, right? So you can kind of crystallize how all this information comes down. So we have an executive summary we'll go through. And this format is what we call doc slides, right? Or doc slides. And so it's a combination of graphics and text. And what I'll do is I will send this to investment committee a week before investment committee so they can read it. And then I have a shortened version of this that will go through a presentation for the highlights and spend more of the presentation answering questions and talking to investment committee about that. So we don't actually read through all of this with the investment committee. So you'll see there's a company history. We, come up with our positioning, what we think, and here's our thesis on why we want to invest. So all the high level details. Then we jump into the opportunity, right? And, there's a study of the market, talk about the problem and solution, a quote from an industry publication. Again, what evidence do we have that kind of backs up what the entrepreneur was saying? we're looking at the market, how big is this market, right? And so we do a little bit of our own checking against what they told us. Then we talk about the product here. What's the business model? There's a few generic slides because this was loosely based on an actual company, and I don't want to, put all their actual proprietary information up. But traction, right? How far are they? How far along have they come? Is there evidence that somebody's paying for what they're doing? Pricing, right? So we really dive into all the details of the business so that we understand what the model is and that it's for real. Here's that cap table again, right? It's an old version of the tool that we use. And again, management, milestones, we get to a rationale, high level, this is why we want to invest, right? And this is the fun part for me, is this is the independent research, right? So this is the section, having been an investment analyst for most of my career. This is where you pull from resources out there that are, third party and not related, so you can triangulate and actually see, okay, there's a real case here, and I've been able to verify it through third party information. And so, you put together the market context. What are the trends? Remember I talked about where are the trends going on? What research there's out there? There's a lot of public research available on the internet now, especially from companies like E&Y, McKinsey, and such. So we kind of really build the case here independently, right? So this is us saying, okay, we see the business case here, and this is not from the entrepreneur. This is our own research into the market and the trends. We talk about, the technology, et cetera. Understanding of the competition, what the competitive advantage is, what's the edge. And remember I said before, anything you need to actually back up your, hey, you're welcome. So Seattle. And so when I said anything you need to back up your case, well, this isn't the standard thing, but in this case, this is for real. I found a company with an analogous business model in a different part of the industry, and that showed how this thing could actually succeed, right? There's an actual pathway to get there. And so there's evidence that this sort of thing has been done before that we can take from. And so I included that as part of this presentation, right? That there's in another industry, something similar has happened. Bit of a risk assessment, right? As we talked about. And then anything else in the appendices, the due diligence checklist we'll use to show, okay, we've checked all these things, certain things weren't applicable, some things are still in progress at the time of investment committee. That happens because we're waiting on documents. Reference calls, right? We'll do a bit of a summary on the reference calls and whatever else is needed. So yeah, hopefully that gives you a sense of like, where does all that information and research go, right? We do all that due diligence and what do we do with it? And that's the document that we use to tell the story of why we want to invest in the company.
Awesome. Hey, Arden, it looks like we got a live question from Ulysses.
Yeah, please.
Right, thank you. Can you guys see me now?
Yeah.
Can you hear me? Yeah. Can you explain a bit more on the process that VCs or standard process most VC will go through to potentially pick winners? If there's a science behind it, if there's science behind the process to pick winners. And I'm gonna explain a question. Can we accredit, if there's science, can we accredit this to science or just luck, right? Because I think there's a little bit of a some sort of a cloud behind the events of picking winners or potential winners, and we don't necessarily know whether there's a standardized process to pick winners or if we can just accredit these to luck. And if there's a process, a decision analysis process, can you just sum it up to maybe the critical success factors that VCs will go through or will look into, the critical metrics of success that will want to have when we analyze a deal on very early stage?
That's the billion-dollar question, isn't it? And I like how you framed it. Is there a science to it, or is it luck? It's a bit of both. And I think for me, particularly coming from being fortunate enough to have professionally managed and invested in 3 different asset classes in my career, I have learned one thing about investing, and that is that there's no guarantees, and that it is never to discount, especially, and this also applies to businesses, is to never discount the impact and influence of just blind shithouse luck. Sometimes the entrepreneur in the business is in the right market at the right time. Sometimes they're not. Sometimes as an investor, you pick a company that, like it's easy to look in hindsight, right? Like when, you see a company that had a massive exit that nobody saw, and an early investor because like, yeah, I was an early investor they could have failed. Nobody knew. But it might just be that this other company at the time suddenly had a need, a change in their strategy, and they suddenly really needed this company, and nobody could have seen that 10 years before. So there is a degree of luck, of serendipity to it. I think, and I mentioned this earlier, the thing about being a professional investor is you have a discipline and a framework that you can explain that helps you to manage risk and to evaluate your decisions. And again, it is a game of risk and reward. It's not about picking winners. I don't like using that phrase because if we could pick winners, we wouldn't need to work, right? You just basically look out there, run through your formula, invest in the stock market. I wouldn't be sitting here talking to you today. I would be in the Bahamas. So, I think what it comes down to in being a disciplined investor is just understanding, it's like gambling, right? Is understanding the risk and reward and then going for it. And then, it's a roll of the dice at that point. But I mean, what kind of odds are you going against? How are you mitigating stuff? I think the big wrench in the system is people. The number of times I've seen companies grow, and because the CEO or founder basically, kind of lost it and decided to take things in a certain direction that didn't make sense. Or there was a co-founder that suddenly, got an ego about him and decided he didn't want to sell the company for a certain price. Or like, there's just so many unpredictable factors out there. I think anybody who thinks that they can pick winners consistently is likely fooling themselves and hasn't, and good on them. There are some very famous venture investors out there who, on the world of Twitter, you would think are, they're always touting how good they are and how they can pick winners, and you've got no shortage of fans. But the best way I can describe it is I used to work in the casino industry, right? Many years I was a croupier. That's where I understood, I dealt blackjack, craps, roulette, baccarat, and I got to observe a lot of human behavior and gamblers, right? Investors. And, there's no shortage of people who will talk about their wins, but you never hear about their losses, right?
And that's a major problem, especially in VC world, because when you look down into numbers, the success rate is very low.
It is very slim.
Like Facebook and Google that have had early investments, we think that every investment, especially in software companies, we think that they're all going to become unicorns, when truthfully, there's only a very small amount of these organizations that receive investments and eventually become billion-dollar ventures. So,
and that's why you have to, as an investor, you have to divorce yourself from the emotion of it and from the ego, right? Take no credit, accept no blame. Run a process. Focus on running a good process, and you'll get a good outcome. Focus on the outcome, you're going to make decisions for the wrong reasons. And, like I said, sometimes it is pure luck. And so all you can do as an investor is feel, I think, the way you measure your own success as an investor is, of course, you have to make returns over time. If you don't make returns for your clients, no one's going to invest with you, right? This is being a professional money manager. But knowing that you have a very clear sense of how you look for value, and that more often than not, or at least enough times it works, that's the best anybody can do. Right. So I wouldn't fool myself into thinking, like, even if I had a company in the portfolio, suddenly we had a $20 billion exit and I could retire, I would never look at that and say, yeah, I picked that winner. It was like, okay, all the factors were right. And it fell into our process, and our process captured that. And I think it's important to remember that as an investor and not get ahead of yourself with your own ego.
Interesting. And lastly, because I want to monopolize the word as well.
Sure.
Can I create this success, or must receive this success to luck or to gamble? What does the due diligence and so-called decision analysis process serves for, except from collecting information that may never be accurate, especially in the case, and we want to focus on stage ventures, right? we're collecting a bunch of informations and 3-year, 5-year projections that are totally inaccurate. Clients that may never get served the way we expect them to. An organization that's going to pivot 2, 3, 4 times before actually becoming successful and generating, $1 million revenue on an annual basis. So what is this due diligence and fake decision analysis process serves for? Because we know that most of this information is totally inaccurate, and I don't want to discredit the
no. I mean, you could absolutely go in there just make
and when statistically it doesn't make sense. I'm just looking at it, like, it doesn't make sense. It's very exciting, but
remember what I said earlier, right? Having a process means you get to revisit it. So you get to look back and go, what was there something else that we missed? What did we look at? What was the factor there that we can learn from? If all you're ever doing is guessing, if you said, I like this entrepreneur, I'm going to invest in that one. And if you're an angel investor with your own money, go ahead. But what ability do you have to look back and learn, right? But if you have your due diligence set and you have your investment memos, like that absolutely allows you to go back and go, hey, we got this wrong, right? Or this is what we were thinking at the time, and this is how we can adjust our thinking going into the future. And like I said, I'm the first to admit that, at the end of the day, there's a big luck and factor that goes into it. No matter how hardworking or smart or intelligent somebody is, you have to hit the market at the right time. But remember I said, as a professional investor, are you going to go, when you go out there and you're trying to raise a $400, $500 million fund, how do you convince a pension fund to invest $100 million with you by saying, oh, we just guess?
Yeah, we need to have ways to explain how we made decisions.
Because it's risk management. It's understanding the risk to reward ratio, and you can't understand that without doing an examination. Also, you could also wind up in those situations like FTX. Right now, the SEC is investigating a lot of the investors, saying, what due diligence did you do? Because you have a duty to look after your pension investors' money. You're people like me and you. So you have to show that you've done some care. There's some legal and fiduciary information. I don't want to be flippant and make it sound like, well, it doesn't matter. It does matter. I just want to make sure that nobody mistakes that for, this is a guarantee we're going to win. This is a guarantee for a winner. It reduces the risk, a lot of different risks, right? And it allows you to formulate your own view of the world of like, okay, this is what's important to us and this is what isn't. And you have to justify your investment. So hopefully that answers your questions. I'm happy to hand it over to Michael. And I'm just wondering if I'm just looking at.
Thank you very much. I appreciate your response. Very honest, very direct as well. Thank you very much.
My pleasure. Thank you, Arden, again. There's one in the chat here, but I'll just go real quick. Just in reference to your the deck you just shared. At that point, when you're presenting to your investment committee, is it you've made your decision, you want to invest in this company, you're confident due diligence is done? What's the atmosphere in the room? Is it sort of, I wouldn't say adversarial, but are you proving it to them? Or are they basically saying, oh, looks like you've got everything together, we're good to go? Or is it more, you really have to proving it, you're a true believer at that point?
It depends, because I have presented to numerous different investment committees for different kinds of organizations. So remember, we're all made up of people. You could have, I've had investment committees that were always combative and incredibly, people who had no clue what you were presenting, didn't prepare themselves. They found their job was to beat you down and to try to find a way to say no. And there's value in that. But I have met investors who were doing that more out of ego than anything. I'm very fortunate. My investment committee is what I would say is collaborative. And what they will do is they'll challenge us if they see the thinking. Right. But they want to work with us to make sure that we've covered the whole thing. The whole point of investment committee for us here is making sure we didn't miss anything and that we are investing according to the thesis, and we aren't married to or we haven't fallen in love with the deal. Right. Just because, this is a hot area, AI, we're on the hype and we'll miss out. Well, then investment committee brings us back down to earth and say, well, your exit analysis shows that you're probably only going to get this price. We might only get a 4 times return on our investment. Is that going to be enough to make the fund? So there's a reality check is probably the best way to put it. But I'm very fortunate to have a great investment committee that's collaborative like that and supportive. But by no means is it a rubber stamp and a pass. That's for sure.
Especially if you've gotten excited about it, I guess, and you miss something like that, or it's kind of a check on that, or the founder being a little too charismatic and being able to sell a little too effectively. Great.
But that's also why for our fund, it's important we have a team approach to it. Some funds have a partner approach where as long as like an individual partner will take counsel from others, but they have the overriding decision. Us, in our group, I think the best way to put it is I was reminded once early in my days with the fund, it's the Accelerate Fund, not the Arden Fund. And so it's important to remember. I say it's very easy as an investor. Don't make no mistake about it. When you're handling money and you're making decisions that are important like that, it can easily get to your head. I've seen it happen to the best of people out there. And it's important to have a team that keeps you grounded and reminded of the responsibility you have and the reality of what you're doing.
That's great. Yeah, I love that too. You have the team that you trust enough that if they tell you you're wrong, you believe them,
Exactly.
Great, thank you. Appreciate it.
My pleasure.
Thanks for staying late.
There's a few, here we go. Are there particular areas where you find yourself asking funds for additional information during due diligence? George, I can't say that there's any one particular, that's why we have a checklist and a process. And every case it just depends on the stage of the company, the industry it's in. But I think the main question we're trying to ask ourselves is, the first question is, what are the chances this is going to succeed, right? Because that's tied into how we're going to make money. And then once we figured out, okay, what our comfort in the level of whether or not this thing will succeed, then it becomes a question, okay, well, how big could this success be, right? And then we kind of work backwards in figuring out the price we're paying and the risk reward analysis. The challenging thing with this is it's not like public equities where you actually have ratios and numbers and a lot of public data, and you can't come up with something like, a Sharpe ratio or something that actually gives you an indication of, okay, the risk to reward is quantifiable. This is more of a gut feel, but it is still necessary to understand if the order of magnitude of the risk and reward analysis, and that's what we try to do. And what sort of soft skills are needed to turn down founders after the due diligence process? I guess it varies and depends on what kind of investor you want to be. I think the way that Pat would put somebody down is different than the way I would put it, and they're not wrong either way, but you can probably tell we have different personalities, and it's different for everybody. But I think for me, the most important thing in turning down an entrepreneur is giving them a rationale and not just leaving them thinking why did you turn me down? We were in this, why are we done? Even before the due diligence process, when we've actually, talked to somebody or somebody has applied, we will frankly say, here's the 2 or 3 reasons why we aren't investing, at least so they understand and know, and there's some learning there. And sometimes it has nothing to do with them. It's just, it doesn't fit our fund. They'll likely find an investor somewhere else. And that's just, that's the way it is. But I think a little bit of empathy doesn't hurt. And respect. I think that's important.
I think we got a good one up there in the chat by Joshua. He said, yeah, sure. He said, what role does social proof play in due diligence? For instance, if you got a cap table and Sequoia or a notable VC is on it, how do you avoid that influence?
I'd be lying if I said it didn't play any role at all. I think the important thing is to understand it's tough to see something like that and be like, oh, no, we're not going to count that at all. You have to do your own analysis, right? At the end of the day. But I think what's important is to understand, why is that investor investing? Every fund is different. Every fund has different dynamics and what they look for. And so if it's another fund that we've worked with in the past, that we're aligned in the same, the way we look at things. Because, for example, if there's a fund that goes in and they're a big name, but we know that they overpay, and they overpay because they have a much bigger fund and they're playing Moneyball. They're out there, they're basically able to invest in, 1,000 companies in the portfolio. That's a different strategy than us. We can't ride on that strategy because we have a much smaller fund. But if we have another fund that we know they do the similar level of due diligence, they look at the same things as we do, and they have enough, capital in order to do a follow-on round. So we're not the only ones that are at risk. That if there's more money needed, sure, that'll have more weight. So it is important not to get starstruck, because as much as, for example, I'm a big fan of Sequoia, right? That was a company I've been following for years, and I kind of learned a lot about venture from following Don Valentine. The Sequoia of today is not the same as the Sequoia of, the 80s when Don started it and their principles. And so I would have to sit back, okay, who's the investor? Why are they? But I mean, there's no denying that there is a certain degree of hype that in certain cycles can help. Very, very much so, especially in the last 5-10 years. Going forward, I think a lot of venture investors have taken a bit of a beating. And so that shine for a lot of big firms might not be as good. But if they're a solid investor with a track record, there may be other reasons you want to follow. But I would never want to go in just for the name. We'll just say that. Any others as we round into the dinner hour? If not, I am happy to make myself available for questions down the road, or see you all at an event. I think it's amazing what you've been able to put together, Evan, Omi. You guys, it's encouraging to see so many students and people interested in the venture space. So having been a finance professional, an investment professional here for as long as I have, always happy to help out, offer any sort of guidance, and talk to anybody about the industry.
Awesome. Well, Arden, thank you so much for your time. Everybody that's still on the call, we will have this recording and Arden's slide deck available after the call. We'll send it out in an email. But thank you for joining us, and make sure that you come out next week for Craig Leonard from Graphite Ventures to go over deal structuring. But other than that, we'll see you next week, and thank you very much for joining us.
Have a good weekend, everyone.
Thank you, Arden.